everyone, Andrea Coombs here with Investor.com, here with today's AskInvestor.com question. This is where we answer the money questions that you are asking. And if you have a money question, feel free to drop it in the comments below and we will do our best to respond. Okay, so today's question is how to start investing. And I just want to start off by saying this is a great question to ask. I started investing in my early 30s, really wish I'd done it in my 20s, but you do what you can do when you can do it. Just get started. Investing is really a great way to build wealth over time. Okay, so first step out of 3 steps to how to start investing is open an account, right? This is open a brokerage account. If you go to our sister website, stockbrokers.com, you can check out this guide for the list of best brokers. Any of the brokers on that list is going to be a great option, but just pick a broker, go to the broker, open an account. Now, one question that will come up is, do you want to open a regular brokerage account, which is also called a taxable account, or a brokerage account? That's great. That's one option. Or you can also choose a Roth IRA or traditional IRA. If you are investing for retirement, either of those can be a great option. Check out this story on investor.com for how to choose between a Roth and a traditional IRA. But when you go to your broker, you can open either just a regular brokerage account or you can open one of those IRA accounts. So just make that choice when you're opening your account, okay? And quick side note also, when you're choosing your broker, consider choosing a broker that offers fractional shares, okay? This is important if you want to buy individual stocks in companies, like say you want to buy some Apple shares or some Ford shares or Tesla or whatever it is. If the broker offers fractional shares, then you can buy little pieces of those shares without having to buy a complete share, and that can really help if you don't have a lot of money to invest. You can get started with $20 and buy a share of Apple if you have access to fractional shares, okay? So keep an eye out for that option when you're choosing a broker if you're starting with a low, just a little bit of money, which is a great way to start. That's how I started when I was in my early 30s. Single mom, not a lot of money. I started investing I think it was $25 a month. It just was something, and I'm really happy I did that now. So highly recommend investing, okay? And look for those fractional shares. So step 2, now that you've opened your account, is just to transfer money into it, right? You need money to start investing. You need money in that account. So brokers make this very easy nowadays. Usually you can set up an online transfer from your bank account to your brokerage account. It might take a few days for the transfer to actually happen where you see the money in your new brokerage account, but it's a very easy process to set up. Another option might be you do a mobile deposit of a check that you want to deposit into your brokerage account. So it just depends on what works best for your situation. Okay, so you open an account, you transfer money into the account. Once the money's in there, step 3, pick your investments. And I think this is the part where people usually, for a lot of people, not everyone, but a lot of people, there's anxiety, uncertainty. How do I invest? What is the best investment for me? And these are great questions. One way to answer that question, I'm going to talk about 3 different ways to invest, okay? One way to answer that question is to invest in a target date fund. These are funds where you pick one based on the year. The target date fund will have a year in its name. You pick the one that has the year when you're going to start withdrawing that money. Okay, so a lot of target date funds are really oriented towards people who are investing for retirement, which is a great goal to invest for. So you pick the year that you think you might retire, and that's the target date fund for you. That target date fund is a mutual fund that invests in a lot of other mutual funds. And just by buying that one target date fund, putting all your money into that one target date fund, you have a completely diversified portfolio. There's a fund manager who is rebalancing that portfolio for you. Everything's taken care of for you. One-stop shop investing, very simple. So that's one way to think about investing, especially for a long-term goal like retirement. Another way is to build your own investment portfolio using exchange-traded funds or mutual funds. That's just how I do it. One way to do that is to look at lazy portfolios. These are model portfolios that offer suggested mutual funds or exchange-traded funds that you can invest in, and you invest in say 2 to 5 of these funds, and you end up with a very diversified portfolio, a nice simple portfolio. It's much like a target date fund, but you are investing in the sub accounts. So we talk a lot about lazy portfolios in this story, so check that out if you're interested in investing that way. Okay. Now, another way to invest is to simply invest in individual stocks, individual companies, right? And this can be a great way to kind of get your feet wet in the stock market, to see what it's like. You know, nowadays, because of fractional shares, you don't need a lot of money to invest in companies. Even if, you know, a single share of that one company is hundreds of dollars, you can get in through fractional shares with just, you know, $20 or some small amount. So by all means, you know, have fun with investing, pick a few companies, invest in them. Just keep in mind that when you are investing in individual companies, this is not a diversified portfolio, right? So say you invest in 3 tech companies and the tech sector crashes, you know, you could lose money if you at that point decide you need to sell your shares. You could be out your money. So investing in individual companies is just inherently more risky because you don't have that benefit of diversification. Okay, and an exchange traded fund or a mutual fund allows you greater diversification because there are more companies that you're investing in. So if 1 or 2 companies fail, others are likelier to be doing, you know, there's more variety in the results. So that can help bolster your portfolio and keep your portfolio from crashing. So just keep that in mind if you choose to invest in individual companies. It can still be a very fun way to get to know the markets and see what investing is like. But if you are investing in individual companies, I would suggest, you know, no more than about 5% of your investable assets, because it's a risky endeavor, and you could put that money, the money is at more risk. Okay, so that is it. 3 steps to how to start investing, and super excited for you to start on your journey. And thanks for watching.